Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. At this week's Investment Policy Committee meeting, we discussed the attractiveness of the S&P 500 valuations from a trailing and projected basis. The S&P 500 is trading at 14.5 times estimated earnings per share for the next 12 months, according to consensus estimates gathered by Capital IQ. Since 2008, the 500 traded as low as 10 times next 12-month estimates. Today, while the 500 trades at its richest multiple since this bull market began, that does not necessarily mean that it's overvalued. Indeed, even at the current multiple, the S&P 500 is trading at an 11% discount to the average next 12-month PE since this secular bear market started in 2000 and would have been trading near 1,800 if its multiple equaled the 13-year average of 16 times. If you are of the opinion that forward earnings estimates are tainted by perpetually optimistic analytical outlooks, consider that at 15.5 times trailing 12-month operating earnings, the S&P 500 is trading at a 13% discount to its median multiple of 18 over the past quarter century. Many regard operating earnings as earnings before bad stuff. They prefer GAAP earnings, also known as reported earnings, which utilizes generally accepted accounting principles. Even using the more inclusive trailing 12-month GAAP earnings per share, the S&P 500 is trading at a multiple of 18.3 times, which is an 8% discount to its 25-year median. So there you have it. Despite advancing 14% year-to-date, 20% since mid-November, and more than 140% since this bull market started, earnings growth has kept pace over the long term. As a result, we think PE ratios based on 12-month trailing actuals or next 12-month estimates look appealing, but not necessarily compelling. I'm Sam Stovall, and I'll talk with you again next week.